Chapter 7, Lesson 2 for the CP Accounting class, describe the impact of adjusting events on the accounting equation and demonstrate how to make and post adjusting journal entries. In the previous lesson, we talked about the accounting equation and the impact that it has when you journalize and you record the transactions. Now we're going to take a look at the next step in that accounting cycle, and that's going to be the impact of adjusting events on the equation. So, what's the purpose of an adjusting entry? Well, adjusting entries are adjust the accounting records for internal events prior to preparing the financial statements. So basically all adjusting entries are going to involve at least one income statement account and one balance sheet account. So that's kind of the purpose. But an adjusting entry, a good example of an adjusting entry is, let's just say we buy supplies throughout the year. Well, we keep buying supplies because we use them. Well, up until now we've only recorded buying the supplies. We haven't recorded actually using them. Adjusting entries would basically shows the company what we've used in that time period, or what we've paid for our prepaid insurance versus what we've used for our prepaid insurance. Another example on that one. So what if? So, these are just entries. Are they important? Well, let's take a look at what if this situation. What if the year and depreciation adjustment was not recorded? So it's the end of the year, and we calculated so much depreciation, but we were a little bit off because our value, we didn't use it as much as we thought we were going to use. So our depreciation would be a little bit off. What if we didn't record it? Well, our assets, in other words, that depreciate, the value of the depreciation, and our net income, because our expense would be off, would be overstated. So we wouldn't have correct, accurate records for our shareholders and stockholders. So what if, let's say, an adjustment for revenue that has been earned but not recorded? So let's just say, let's go back to that unearned revenue liability again, and let's just say we needed to create that adjustment that says, okay, you know what, hey, we earned it. But it hasn't been recorded. Well, guess what? Net income and assets would be understatement. We would actually have more revenue. We would actually have had, more cash, which would give the shareholders and stockholders a wrong picture. We need to make sure that we give them accurate pictures, especially when we're public, especially when we have shareholders and stockholders. Well, what if an adjustment for an expense that has been incurred but not yet paid was recorded? So let's go back to that supplies expense. Let's say we did use $500 worth of supplies, but we didn't record it. Well, our net income and our assets would be understated, correct? Because it would say we have more assets than what we really do, and we have more, in a sense, net income than what we really do when we have more of an expense. So you need to make sure that you do these adjusting entries so you don't overstate and understate your various financial information. So before we get into it, let's talk real quick about kind of four key terms, and it's going to be revenue accrual and revenue deferral, expense accrual, and expense deferral. Well, revenue accrual is an adjusting entry that occurs when revenues are earned in one accounting period and payment is received in a later period. Revenue deferral is an adjusting entry that occurs when a company has been paid in advance for services to be performed in a future period. This would be this unearned revenue that we talk about, that liability account called unearned revenue, which you heard about a lot in that previous lesson. Expense accrual versus expense deferral. Expense accrual is an adjusting entry that occurs when expenses are incurred in one accounting period and payment is made in a later period. Expense deferral is an adjusting entry that occurs when a company uses previously purchased assets in an attempt to generate revenue in future periods. So kind of a little chart to make this hopefully a little easier for you. If you look at an accrued revenue, now for an accrued revenue, now revenue is recognized. Remember, revenue is always recognized at the time of the sale, not at the time you receive cash. Okay, but a revenue referral means the sale happens now, our cash is going to be received later. An accrued expense, our expense happens now, but we don't pay for that expense until later. Okay. Now, if you think about deferred revenue, cash is going to be received immediately, and revenue is also recognized later. Okay, and we'll talk a little bit about that. That's that unearned revenue, and that's that liability account. I keep going back to that unearned revenue, but that's really a key thing for this chapter. Deferred expense is where cash is paid, and our expense is recognized later. So let's just say we say, okay, you know what? I'll pay you $500 to snowplow our parking lot, and that's $100 per time. I'm going to pay you $500. I want you to come out 5 times. Well, the expense is recognized later once it's performed. So for each of the, let's take a look at a quick little example here. For each of the following situations, prepare the adjusting entry for the month ended April 30th and indicate the effect each adjustment would have on net income. Marketing is $20,000 contract with a client to prepare a catalog describing the client's various products. Payment was to be received when the catalog was complete in June. As of April 30th, $9,000 worth of services has been performed. So, in that case, what our transaction is going to be is we're going to debit accounts receivable because that asset's going to be decreasing, okay, and we're going to credit our fees earned, okay, in that case. So our net income is increased by $9,000. Donna's Consulting, a decorating firm, has an agreement with an apartment developer to decorate the apartment offices and model apartments. Donna will be paid $12,000 upon completion of her decorating services. As of April 30th, Donna has completed 1/4 of her decorating services. So on April 30th, her accounts receivable, she's going to debit that $3,000. Her decorating fees earned are going to be $3,000. Her net income is going to be increased by $3,000. Grant Enterprises rents storage space to a tenant for $200 a month. The invoice for April's storage fee has not been sent as of April 30th. So on April 30th, we're going to have accounts receivable as $200. Our rental income is going to be $200. And that's a revenue account there. Therefore, net increase is increased by $200. For each of the following, let's take a look at another one. For each of the following transactions, prepare the adjusting entry for the month ended October 31st and indicate the effect that each adjustment would have on net income. So Wingbach Plumbing has a $35,000 contract with a construction company to perform plumbing services for a home under construction. Payment was to be received at the end of the job. As of October 31st, $8,000 of the services were performed. So we're going to debit our $8,000 accounts receivable. Our construction fees earned are going to be $8,000. Therefore, our net income increased in that one. Okay, because in net construction fees earned is a revenue account. Hutchinson's Bank made a $10,000 loan to customer on October 1. The terms called for principal interest of 8% to be paid at the end of the year. Hutchinson State Bank prepares monthly financial statements. So their interest receivable is $66.67, or in other words, your 8% of the loan for and it's 1/12 because they do the monthly financials. Okay, their interest earned then is $66.67, and therefore their net income has increased. Davis Inc., a real estate company, rents office space for a lawyer for $1,200 per month. The invoice for October had not been sent as of October 31. So our accounts receivable is $1,200. Our rental fees earned is $1,200. Our net income will be increased. And kind of finally here, for each of the following situations, prepare an adjusting entry for the month ended August 31st. Indicate each effect to have on net income. The August water bill for Johnson Company arrived in the accounting department on September 2nd. The invoice totaled $135. August 31st, we're going to debit our utilities expense. We're going to credit our accounts payable of $135. Our net income is decreased by $135 because we have that expense. Riverside Medical Clinic has a contract with a payroll provider for payroll services. Riverside pays its employees semi-monthly. The payroll provider charges Riverside $250 for each payroll it processes and bills on the first day of the month after the services are provided. So what are we going to do? Well, on the debit, we're going to debit our payroll service expense. It's $250 times 2 because they pay their employees twice a month, and my payroll service payable is going to be a credit of $500. $250 times 2 because they pay them twice a month. So my net income then is decreased because I have an expense. My net income is going to be decreased by $500. Cameron Inc. borrowed $2,000 on August 1st. Cameron must repay the principal and interest 9% annually, 90 days from the date of the note. Cameron prepares monthly financial statements. So on August 31st, okay, so we're on August 1st, August 31st, their interest expense is going to be $15. That's going to be your 9% of 90, okay? Your interest payable, once again, it's a 9% annual 90-day compound interest. I'm sorry, 9% annual interest, but basically they've only used it for a third of it, so they haven't used it for the full amount. So it's a third of the interest, and that's interest payable. So our net income, because we have that expense, our net income will be decreased by $15. Analyze the following events and complete the requirements here. So Yarborough Industries purchased buildings costing $240 and land costing $190 by paying $43,000 in cash and signing a note payable for balance. Well, our assets will increase by $430,000 and decrease by $43,000 because our cost of our building is going to be $430,000, but we also paid $43,000 in cash. Where our liabilities then will increase by the difference, which will be $387. Kui Manufacturing has an obligation on its books for $15,000 owed to a supplier. Kui purchased an additional $8,000 in equipment from the supplier, making an immediate cash payment of $23,000 to pay both the current and previous purchases. So what's going to happen here? Well, our assets will increase by $8,000 and decrease by $23,000. Okay, so we purchased an additional $8,000 in cash, and then $23,000 to basically pay for the previous purchases. So we bought an asset and we paid off an old liability, and our liabilities decreased by $15,000 because our So GPS Systems has a right to receive $3,000 from a customer for the purchase previously made on account. GPS Systems sells $8,000 in materials to its customers and receives a check for $11,000 at the time to pay for both the current and previous purchases. The materials had cost GPS Systems $2,000. So what's going to happen here? The assets will increase by $11,000 and decrease by $5,000. And that $5,000 gets us a $3,000 for accounts receivable and $2,000 for inventory. Our owner's equity increases by $8,000 and decreases by $2,000 in this case. And then finally, Kelsey Corporation purchased merchandise on account at a cost of $19,500. Kelsey then sold the merchandise to a customer for $34,125. Well, our assets will increase by $19,500 and liabilities will increase by $19,500. Then the assets increase by $31,125 and decrease by $19,500, while owner's equity will increase by $34,125 and then decrease by $19,500.